Welcome, everyone. Thanks for joining us. I'm Tiffany Sang, Head of DB, LGPS and Investment at the PLSA. And it's my pleasure to introduce our session today, a very important topic in our policy in practice webinars running all this week. So maybe some of you have even caught some of the other ones as well, or will today and tomorrow. A very important topic in our policy in practice webinars is that today, given the times that we live in this persistent uncertainty, the topic is the DB risk management journey. So there's obviously a lot to unpack in that umbrella theme. So I'm joined here today by Alistair McIntosh, who is a partner at Aon, and he's going to lead us through the findings of Aon's Global Pension Risk Survey. So Alistair, do you want to say a quick hello to the audience before we go on to some scene setting?
Yeah, morning, Tiffany, morning, everyone. Great to be here and opportunity to share the findings from the survey today.
Oh, thanks so much. I'm really looking forward to hearing more in depth some of the analysis that you've done in this important space. So the survey, for those of you who don't know, runs every 2 years. So it'll be really interesting to see what risk factors have had impact, have changed, have not changed since the pandemic has hit in early 2020. But first, as I mentioned, I thought it would be useful for me to just highlight some of the more significant milestones in the policy and regulatory landscape in recent times for DB schemes to provide a bit of a context where some of the survey results can be understood within. So some of the things I'll be covering quickly include the general funding position of schemes on aggregate. I'll recap some of the context of the DB white paper from 2018, which has really propelled us into some of this space now. Some key elements of what we know so far coming out of the funding code, as well as a general state of affairs with consolidation. So as most of you know, I'm sure there is just about 5,300 DB schemes now in the UK. And the great news is that the DWP green and white papers have concluded that the majority of DB schemes are healthy, well managed, and there is not a widespread effectiveness issue across the landscape as a whole, which is fantastic. Though we wouldn't be here if we also didn't know that there were some red flags to consider. So there is data from TPR that indicates that there's an estimated 3 million members in schemes with a high risk of employer insolvency, resulting in possibly benefits not being paid in full. So obviously 3 million scheme members is not a figure to be ignored. So without proactive action, we all know that it's unlikely to change in the near future, even though I think it's something around £400 billion of scheme payments have been made by employers over the last 10 years. So it's important to kind of make sure that we keep our eye fixed on what we can proactively be doing. So as we all know, severely underfunded schemes clearly present a risk to not only member outcomes, the PPF, but also PPF levy payers, of whom many of you in the audience are. Good governance is, of course, something very important to consider as well. I know Alistair will touch a bit on this as well in what he'll be sharing with us momentarily. DWP's white paper, again launched in March 2018, sets out a series of proposals to strengthen the scheme's funding positions. And it included, amongst these proposals, a revised funding code. So DWP is convinced as well as of the benefits of consolidation, which could come in multiple forms. It could come from merging administrative functions, to buy-ins, buyouts, and of course to superfunds. Just taking the first one, funding code, the PLSA is of course supportive of the intention to clarify the funding code, so long as the needs from the DB industry are seriously integrated into the code. And I know some of you in the audience who work with me closely will know that we've been in active conversations with TPR in various ways. And some of the things that you've told us, our members, to push TPR on include things like making sure that bespoke is truly bespoke rather than just fast track plus, ensuring that the bespoke track really shouldn't be overly cumbersome to achieve. It's important as well to ensure that there's sufficient flexibility for open DB schemes, that there are achievable goals set for closed DB schemes, and that multi-employer DB schemes need to be factored in appropriately as well, so that there's a suitable regime for them. So I think the latest news, I mean, we've been waiting for months and months now, but I think that the latest news on the grapevine is that the second consultation is due to drop sometime in Q1 or Q2. So we'll just have to wait and see. We also still hear from government, of course, that there is still enthusiasm from consolidation in all its different forms. And in fact, just yesterday, TPR announced that Clara Pensions has been named as the first superfund to be officially cleared by the regulator, in case you missed that news. So now the scene is set. I hope I've sufficiently reminded us all of some of the key background issues that will inform our discussion today. We have a healthy DB landscape. There are safeguards available, but risks abound still. So I'll turn it over now to Alistair to lead us through some key things to think about on how to approach these old and emerging risks. And don't forget, as we go along, please do put your questions in the Q&A box on the right-hand side, which I think you can click on from the bottom as well to make it come up. And I'll do my best to pick them up when we get to the Q&A section with you. So Alistair, over to you. Thank you.
Yeah, many thanks, Tiffany. Just a brief introduction. Yeah, I'm a partner in Aon's retirement practice. I'm a scheme actuary to a range of schemes, all sizes. My smallest is £2 million, and my largest appointment is just over £10 billion. So I've got the full range of schemes covered. But I'm here today as lead of Aon's Global Pension Risk Survey. As you mentioned from the title, it is a global survey. We will look at trends in DB pension risk around the world. Concentrating today on the UK findings, and if we flick onto the next slide, just for a bit of background to the survey, I think I would best describe it as trying to answer the question that I get most often from my clients, which is, what are other schemes doing? It's a survey that looks at all the risks that are facing DB pension schemes, assets, liability, governance, and we'll touch on them all today, and many more beside. Tiffany mentioned we've run it every 2 years for over a decade, so we've really got the evolution of risks and been able to sort of plot time series of things, and actually then see the risks that are sort of emerging now that weren't on people's radars 10 years ago. It covers a full range of schemes. I've put a chart there showing scheme sizes. So we've got 15% of respondents up to £100 million. The other end of the spectrum, 11% of respondents were over £5 billion in asset size. Other bits to note, I guess, it's about 60% trustee responses, rest in mainly people in corporate roles such as HR, pensions managers, predominantly private sector response, about 10% of respondents from public sector, and I'll pull out some of the differences that come through there, and a bit of background just from timing, because we can't really do anything at this point without talking about the pandemic. Survey responses collected in June and July this year, and one of the questions we asked was how people's sponsors reacted to COVID. 55% of respondents had said COVID had a negative or slightly negative impact on their sponsor. About 26% little or no impact, and 19% some variation of positive. But whilst that was the sponsor bit, I think, as Tiffany alluded to, scheme funding, whilst it took a dip in 2020 at the onset of the pandemic, has rebounded quite strongly. Looking at Aon's client base as a whole, from the beginning of 2020 up until the middle of this year when we were doing this survey, more than 75% of schemes have seen an increase in their funding level. So schemes generally moving in the right direction, and that's also something that's coming through in the results. So I'm going to dive through some of the highlights. There's a lot more in the survey itself, so please look out for that. If there's anything in particular you want to cover, please do stick it in the Q&A box that Tiffany mentioned, because we've got plenty of time for questions at the end. So if we move on to the next slide, I just wanted to start with a sort of overview. What was my key takeaway from the survey? I think it is the range of risks that schemes are facing now. Put a word cloud together of the themes that came up in the survey responses. And there's words in there that have been familiar to you when we did this, when we've done this survey, 10 plus years ago, things that have always been on people's lists like equity and interest rates and longevity risk. There's now a lot more items like cyber and member engagement and governance that are coming to the fore more than ever before. And I think it's that range of risks that schemes of all sizes are having to address that is my key takeaway from the survey. If we move on to the next slide in a bit more detail, starting with long-term targets, some good news here on long-term targets. They are getting both stronger and closer. So we've put here the how they've developed over recent years. This is the first survey where buyout has overtaken self-sufficiency as the most popular long-term target for schemes. That's the chart on the left-hand side there. We've I think that's driven by the funding improvements that we've seen. I think it's something that's a bit more realistic for schemes as funding levels have improved. The growth of insurance market has also meant that it's more realistic for the largest schemes as well. I've got a couple of multi-billion-pound schemes myself that were previously very much in the self-sufficiency target, but as buyouts become more realistic for them, they're switching to target an ultimate buyout goal. On the right hand side, as I say, that timescale's coming down. It's turning a corner, not necessarily by the by the 2 years you'd hope for every survey, but I think I was taking that as an overall positive news, as some people are dropping out of the survey having reached their target, and when you combine it with long-term targets themselves getting stronger, I think that's a very positive message. Couple of bits here that I'd draw out, just going back to the left-hand side. Obviously, 47% buyout and 34% self-sufficiency does leave a proportion of schemes targeting something else. There are schemes out there that yet to set a long-term target, and that's probably one of the bits where we see some of the public sector schemes in that scenario, where particularly those that are still open to new members, they're often in a very different place to some of the private sector schemes that have possibly been close to new members and accrual for a number of years now and are very much in runoff. So long-term targets really do depend on your circumstance. And one bit that we did ask as part of the survey responses was a consolidator option. Nobody selected that they were targeting consolidated, but the sort of, for this webinar, the timely news yesterday of the approval of Clara and pension super fund being in that sort of market as well, and in the process of being assessed by TPR. Be interesting to see in the coming years how that develops, and whether we do get consolidators sort of appearing as a large sort of proportion of this as a third option alongside buyout and self-sufficiency. On the next page, we've put a chart on how schemes are trying to get to their long-term target, whether that's buyout or self-sufficiency or something else. I'd start with the second bar in there. Great to see that 54% of schemes have got a funding plan that's going to get them to their long-term target, and all they need to do is stick to it, and that's exactly what the regulator is aiming for with its funding code. And 52% of that start at the top of schemes considering their flight plan robust. We've seen a lot of schemes revisiting their flight plans post-COVID. Describe it, did it survive contact with reality? And actually pleasing to see that of those who have reviewed their flight plans, about 60% of that proportion of that population found that it didn't need to make any changes. The rest of making some tweaks, but great to see the opportunity to have, in sad circumstances, tested flight plans and seen how they react. What are the elements of key flight plans? Well, probably unsurprisingly, asset performance, key element. A third of schemes relying on increasing maturity, making the target easier to reach. If anything, I'm a bit surprised that's not higher, because maturity is the one thing that's going to happen to everybody. These schemes are going to mature over time, and that is going to help funding position, particularly those who are targeting buyout, with the difference in pricing between non-pensioner and pensioner liabilities. And what I'd call out on the right-hand side there, additional contributions beyond the agreed funding plan. Slightly nervous to see 24% of schemes relying on contributions that would appear not to be documented at the minute. Good. I mean, when we asked this question in 2019, a couple of years ago, it was 46%. So it is coming down. I think my call to action is anybody who finds themselves thinking that they're, particularly if on the trustee side, and they're thinking of relying on extra contributions from their sponsor, do try and get those documented, so that when push comes to shove, you're going to get them. If I flick on to the next slide, member options was something that's forming part of people's long-term plans, or ways to get to their long-term plan. But I think the use of member options is not just driven by risk reduction and potential funding improvements. I think there's general acceptance that they are useful tools in their own right. Supporting members and member engagement is really important. There's been a big pickup in things like quoting CETVs in retirement packs post the freedom and choice legislation in 2015. That's still coming through in the numbers. If I look back at the 2017 survey, for example, only 30% of schemes were quoting CETVs at retirement. That's now up over half. Number of schemes that have implemented a partial transfer option for those who want, possibly the best of both worlds, the ability to take some of their benefits in the form of DC, but have a guaranteed DB income. I can see being attractive to many. A couple of other options I think it's worth calling out. Retirement pension increase exchange exercise. That's another one that's stepped up from 9% in 2017 to 19% now. A lot of schemes looking at combining a pension increase exchange with GMP conversion, if that's the way that they're looking at doing GMP equalisation, trying to turn what could be a particularly tricky message about equalisation and communication exercise into a positive member choice exercise. And another one at the bottom there on bridging pensions. This is another one that one of my schemes has implemented last year. So I've got some schemes that have got it in their rules. Other schemes are putting it in as a new option, giving people the ability to reshape their pension, so to get a higher pension on early retirement for the period up to state pension age, and then dropping down, with the idea being that when combined with the state pension, it should provide a roughly level income over somebody's life. But it's really helpful for one of my schemes going through restructuring exercise post-pandemic, because it allowed people to take early retirement when they might not otherwise have been able to afford it. I will pause for a glass of water. I don't know whether there are any questions so far, Tiffany.
Not yet. I think everyone's still listening intently, but I'm sure they will come. So be sure to put them in the Q&A box, and I'll keep an eye on that as well as we carry on with the presentation.
Great, many thanks. So if we move on then, a couple of slides, next bit on investment asset risks. ESG is something that was definitely not on the radar of our survey. Probably even sort of 4 or 6 years ago, never mind 10 or more. It's something that's really come in very quickly. And when I look at this, I think 92% of respondents have either got or are putting in place an ESG policy. So yes, there's lots of regulations that are coming in the ESG space. It's clearly an area of great developments, but a lot of the things that have come in so far, like TCFD requirements that have applied to the largest schemes. I think what we're seeing here is schemes of all sizes are taking action here, and 20% of respondents have gone as far as making changes to their investments as a result, investing in things like climate conscious equity funds, things that don't invest in coal producers, credit funds for green products. We've seen green gilts issued recently, and other things linked specifically to ESG. So this is very much a growing area. I think it's probably one of the areas when I look forward to 2023 and beyond. I think this is going to be a big focus on the investment in the investment space. The next slide has got some some of the less surprising bits on assets. Schemes are continuing to de-risk, moving out of equities and other growth assets in a lot of cases into liability-driven investments and credit. I put the stat at the top there that 74% of respondents have interest rate hedge ratios above 80%. Very similar stats on inflation hedge ratios as well. And that is a marked improvement from 2019. Only 45% of schemes were more than 80% hedged in 2019. So big step up in hedge ratios. I think that's been a big driver in what's happening with the with funding ratios coming through. So that's I think that's worked. That's worked there. The other bit that I think is worth pulling out there is illiquids. It's some people are reducing their exposure to illiquids if they are heading towards bulk annuities in particular, but some are, if they're aiming for self-sufficiency and planning to run the scheme on for a long time, then illiquid assets are something that could be a long-term investment for everybody. If we go on to the next slide, just picking up a few sort of what I describe as hot topics from the survey. Cyber risk is definitely going very quickly up people's agenda. Cyber attacks have more than doubled since 2019. It is a small base. We had 3% of respondents in 2019 reporting that they'd been victim of cyber attacks, and that's now up to 7%. Probably not surprising given what we've seen elsewhere, in sort of general society with cyber attacks, and obviously pension schemes, not just significant asset holders, and but also personal details of members that attractive to criminals. Lots of different actions you can take here, assessing third-party risks and excuse me, creating incident response plans, particularly popular. I think I'd add to the incident response plan, once you've drafted an incident response plan, a lot of schemes looking at running a war game to work, check whether it works in practice. And of all the areas in the survey, when we were analysing responses by scheme size, I think this was the one where I was expecting, this cyber risk to be something that large schemes were on top of, and smaller schemes, were a little bit lagging behind, and that really wasn't borne out by the results. Sort of schemes of all sizes were, equally good and bad, in terms of whether they'd done or were planning to do these these various actions. So there's a bit of a call to action for all schemes to review cyber risk, because it does seem only to be heading in one direction. And finally, for the slides from me in terms of a whistle-stop tour of on the next slide, just pulled in some stats on GMP equalisation. Appreciate it doesn't affect every scheme out there, but for those where it does have an impact, it's going to be a significant project. Probably is already being a significant project, and that's going to continue for coming years for a lot of schemes. What would I pull out as the highlights here? Well, 46%, nearly half of schemes have made a provisional method decision. So lots of work and activity going on in the background. The data cleansing is going to be the sort of key activity before the sort of uplift calculations can start in earnest. There's clearly a lot to do there. I do think it's one of those areas that benefits from a step back to work out what's proportionate. And also, if you're looking at records for GMP equalisation, is there anything else that you would need to cleanse records for? Can you go back into paper files once and extract all the information that you need? A third of schemes are now getting on with the process of implementing, but clearly going to be a long tail of that over the coming years. And the other bit I'd pull out there is transfer values, and obviously the 2020 ruling in the Lloyds Bank case confirming that historic transfer values will need to be equalised. Less than a third of schemes have equalised transfer values going forwards. I think there's an opportunity there for schemes to make sure that they've equalised going forwards. That's sort of capping the problem for now, and also giving you a base to go back and calculation routines probably to go back and look at historic transfers. So when you take the 2018 and the 2020 rulings together, no respondents to our survey had fully implemented yet. That's obviously going to pick up in coming years. Be interesting to see where that is in 2023, and we'll start to develop a bit of a time series on all of that. So those were all of the slides that I had to cover, sort of picking out my highlights. As I said, there are a huge variety of risks sort of highlighted by the survey. Very interested to get your questions on bits that are concerning you, and I can hopefully provide some pointers on what the other what other bits of the market are looking at in those areas.
Thank you so much, Alistair. That was really great. I learned so much just listening to you just now. There's so much to unpack there, and I know we've got a question that's come in. But just I thought I'd start us off with a kind of a broad one. As you say at the end of your presentation, that there's a broad range of risks. Would you say that the same risks affect all schemes equally, or is there a profile that you've done of schemes where some schemes will be more susceptible than others to some risk than others? What advice would you give in this space?
Yeah, I mean, the short answer is absolutely not. The same risks don't apply equally to others. It really depends on your scheme specific circumstances, your sponsors circumstances, the change that you're at in the stage that you're at in your journey plan. Are you well funded and heading to your long-term target? Are you still trying to get to full funding on a technical provisions basis? Those schemes in that scenario probably haven't necessarily started thinking about long-term targets. And I think that that's where the maturity concept that obviously runs through the heart of the regulator's funding code. If I was going to boil it down into one bit of the spectrum, I do think that is the bit that is most likely, schemes of similar maturity are most likely to affect, you'd be facing similar risks, but even within those, member circumstances, sponsor circumstances will change the dial depending. So you do need to look carefully at your specific circumstances.
That makes perfect sense. I wanted to move us a bit just into thinking about, I know you had a section in your presentation talking about member options. Could you tell us a bit about what are some of the main barriers for schemes who don't offer member options?
Yeah, so I think a lot of it is probably now sort of administration capabilities, and do they have the ability to do things automated, or particularly DB schemes with complex benefits? Does that require lots of manual calculations? That means providing transfer value quotes, for example, every time you do a retirement pack, becomes a bit impractical. I think what we are seeing even in that space is, even if schemes can't provide something for 100% of their members, if they can automate it for 80-90% of their members, they are moving to do so. It has probably been a bit of a sort of sea change. If I go back probably 5 years, not long after the freedom and choice legislation came in, there was a sense that member options were exercises particularly led by sponsors, aimed at reducing the deficit. I think that has shifted. They're equally likely now to be led by trustees. So a lot of trustees have overcome those sort of that nervousness about promoting things, that I think they see that there's risk in saying nothing, and members don't realise that these options exist, even if you're not providing new options. Just making people aware of the transfer value and other options that they've already got is worthwhile. Absolutely.
You mentioned freedom and choice. So it's interesting. I know not everyone in the audience probably would agree that freedom of choice was a good thing or bad thing, depending on who you ask and the reasons. But there's a question that's come through from Peter. He asks, member options aren't always good in terms of benefiting the pensioner financially. So pension bridges and PIE come in both beneficial and non-beneficial flavors. Do you have a split?
So there. I haven't got the stats to hand on sort of value shares and stuff. I think that the key thing I would draw out with member options is, and it was a chart that I thought about putting in this presentation and didn't, is the support that goes alongside it in terms of offering IFA support and technology support. Because even something that might, in an aggregate level, if you take a pension increase exchange exercise with a particular value share, that might be a value share at a macro scheme level, but for an individual, it might still make sense because of their circumstances. So it's I guess it's combining the options with the access to the support, whether that's technology and modelers or guidance or IFA, formal IFA advice, depending on the exercise. Essentially giving members the choice, and letting them take the decisions, I think is where we're seeing a lot of schemes heading, if you're giving them the support to do so.
No, I think that makes perfect sense. I hope, Peter, in the audience, I hope that's answered your question. Panning the camera back a little bit now, back again. I know one of the hottest topics for all of us now is responsible investment, and illiquids. It's the protective finance stuff that's been in the media, the investment big bang that the Prime Minister has announced. How do you see illiquids? Well, first of all, taking the illiquid question, how do you see illiquid assets playing into portfolios depending on different long-term targets? What is your guidance in this area?
Yeah, it's going to be very sort of scheme specific again, depending on what you've got for your long-term target. I mean, if you're planning to run on self-sufficiency target, then illiquids can very definitely form part of that portfolio. And where we see them used, we see a wide variety of liquids being used, private equity, real estate, infrastructure, direct lending. So lots of different options out there for illiquids. If they're generating relatively stable returns, then that's exactly the sort of thing that that would help pension schemes. And I can see why the government sort of put it out there and is wanting to encourage it. I think the tricky bit comes for those schemes who are targeting buyout in a short timescale. I mean, if you're targeting buyout in 10 plus years, I think there's still definitely a place for liquids. I mean, you probably need to be conscious of what happens if your funding improves much quicker than you're expecting, and you get there a little bit earlier. Although there are solutions of secondary markets and what have you. For those that are really close to buyout, it's probably unlikely that illiquids are going to be the answer, but that still leaves plenty of schemes out there where they will be the solution. But think about your circumstances with everything.
Absolutely, that makes perfect sense to me. So you mentioned buyout, and I was very struck in your presentation actually when you said that buyout has overtaken self-sufficiency as a long-term target. Can you tell us a bit more about what does this increase in schemes targeting buyout mean for the insurance market?
Yeah, I mean, that's one of the bits that sort of been interesting in recent years in terms of more schemes are targeting buyout. Is the insurance market going to be able to cope? And I think to date it has. I mean, the volume of bulk annuity transactions, longevity swaps written in recent years, I think the stat is it's tripled in the last 5 years. There's from everything you hear in the market, there's room for it to grow further. It's there's plenty of capital out there that the insurers and reinsurers have got to access. So I think it's the schemes being ready to go to market and making sure that when they get there, that they're putting themselves forward in the best light to the insurance market. If there are going to be so many schemes out there for the insurers to bid on, it'll be the insurers who get to choose between schemes rather than the other way around potentially. So making sure you're well prepared is going to be really key there.
Absolutely. You mentioned the need to be well prepared, and I guess one question I had looking through the full report as well is that the report, and you mentioned as well in your presentation, that data cleansing, GMP equalization, these are all things that need to be factored into strategy. So is there any advice you can give trustees and pension scheme managers out there in the audience now on how to start preparing for dashboards, for instance, or anything else that you see coming down the track that they need to be thinking about in terms of being this theme of being well prepared?
Start early. I mean,
Start early.
Yeah. I mean,
I
mean, if I was going to take one thing away from this sort of survey to talk to my clients about, it is data, because it just comes up in so many bits. So obviously it comes up in GMP equalization. It comes up in dashboards, as you meant. It comes up in going to buyout. I had a scheme that got to full funding on a buyout basis in late 2019. It actually took us 18 months to be able to go to market because we had a lot of data work to go now. Thankfully, funding levels in aggregate continued to improve, but we could have had the situation that funding had deteriorated, and by the time we had the data ready, we weren't able to afford it. So I think there's a lot of there, and as I say, I think it's sort of thinking through almost part of a long-term plan. Don't just think about the funding and investment bits, but think about the governance. Think about data. Think, well, actually, by the time I get somewhere in 5 years' time, 10 years' time, I'm going to need to have got all of this information for dashboards. I'll need to have got contingent spouses pensions was the big issue on my scheme, calculated because they weren't stored on records and they wanted to go to buyout. So, okay, I've got to solve GMP equalization. That's my 2022 data project. But while I'm doing that, can I, look in paper files once and find, these other, 3 or 4 items that I'm going to need. Otherwise, you'll come back in 2024 going, oh, I need to find something else now. So yeah, but starting early is starting yesterday is probably what I wish I'd done on some of my schemes.
Absolutely, starting early, just like what people tell me every year about my Christmas shopping, which I haven't started yet. So anyone else in the audience who hasn't done it yet either, I'm with you in that boat. So one of the other big kind of rocks in the last kind of few years, as I mentioned earlier, is so we've got the liquids piece. That is a really strong thing that's coming through from the government as well from a policy perspective. But then we've got, of course, the responsible investment stuff. And you mentioned TCFD, and anyone who in the audience who works with me really closely in some of our consultations will know that there's just been a barrage of stuff around TCFD. And in your presentation, you flag the shifts that have been happening. But given the pace in which everything is happening, is there anything that you think our audience should sort of say, okay, hold on a minute, these are things that we should think about, these are some, absolutely we need to be all moving in the same direction in terms of trying to do our bit for climate change and the other factors of ESG as well. But are there any risks that really should be thought through, a series of questions, anything you would advise the audience when they're perhaps coming to a review of their approach towards ESG and climate risk?
Yeah, I think the opportunity here is obviously there's, whenever you get regulation, there's a tendency to work out what's the minimum that you can do to comply with regulation, and that will be the right thing to do for some schemes. But I think for a lot of schemes, there is that opportunity to sort of go, well, why are we trying to do this? And actually a couple of my schemes, it's been interesting because what's happened on the DB scheme side has been driven by the DC members. They've got DC sections to their trust, and members on the DC side have been really engaged with ESG funds, and they've put them in, and they've got a track record or starting to build up a track record of good returns, and it's made them easier to sort of port across to the DB side. So it is trying to work out what you're achieving, linking it in with your sponsor as well. I think virtually all sponsors these days will have climate related, in particular, sort of metrics and targets in their business plan. That's a good good place to start to integrate great things. So yeah, plenty of opportunities, and be really interesting to see how that comes through in the 2023 survey and beyond, because I'm sure it's going to be a hot topic for many years to come.
Absolutely, I think framing it as an opportunity is absolutely the right approach. I think we have time for about, well, I think we could squeeze in another question or two. I think I hope my colleagues running the text aren't going to kill me. So can you tell our audience what is the key action that you are taking with your clients at the moment?
Yeah, for me it's data. It's just, okay, we've
Data.
got data and but putting data in the context of a long-term plan. So one of my biggest clients he's got a triennial valuation next year, 2022. It's having that long-term target self-sufficiency debate. What's its ultimate target, and it's putting that in the context of, okay, well, regardless of whether we decide that we're going to aim for buyout or self-sufficiency, here's a long list of things that we're going to do, member options, GMP equalization, and it's the data that underpins all of that, basically.
No, that makes perfect sense. So we've run out of time, so I'm going to have to start to wrap up. I'm going to ask you one quick question. What do you want to see in your next survey? What are you most interested in seeing?
I'm most interested in seeing what happens with consolidators after, it's sort of been on the horizon for so long that we even had it as an option in the 2019, survey, is anybody targeting a consolidator? Nobody said yes 2 years ago. Nobody said this time. But as we said, we've got the Clara news now. That market has the potential to develop quite quickly. So it'll be interesting to see what happens there.
Absolutely, I'm completely with you on that. And the PLSA supports consolidation in principle and Superfunds as well. So it would be great to carry on this conversation with you, Alistair, with others in the audience as well, elsewhere where possible. So so thank you, Alistair. I'm just going to close up now quickly. So if you can stay with me for just 60 seconds in the audience. So we've got a feedback survey, which I think will come up momentarily. If you could fill that out, that helps us as well to do our jobs better in the future for you. I've been asked to tell you as well that the slides and video for this session will be sent to all attendees after this event within 48 hours, and it'll be available on our website as well. We have a bunch of other events coming up next year, which is really exciting. So we've got our ESG conference again in March, which will be digital, but then we're going to go back to our live events, which I'm super excited about. I've really missed hanging out with all of you actually and having these conversations over a cup of coffee. So our investment conference is returning in Edinburgh in May, local authority one in June in Gloucestershire. Our annual conference again is in October as per usual in Liverpool. And I guess the last thing to say really is to thank you in the audience for your time, your patience, your questions, and also Alistair for taking the time to give us his expertise on these very interesting findings from his survey. So thank you all very much, and I look forward to speaking with you all again soon, hopefully.